this afternoon, the focus turns back to the Federal Reserve and some crucial minutes from the last meeting. Minneapolis Fed President Neel Kashkari says that the central bank has made some progress, but inflation is still too high. Last week, San Francisco's Mary Daly told Yahoo Finance that she's looking at all the information and not just data. Let's see what our guest host today is looking at. Katy Kaminski, AlphaSimplex's chief research strategist and portfolio manager, here live in living color. Thanks for joining us in studio this morning.
Thanks for having me.
Absolutely. So let's start with the Fed as we kind of teed up there and off of some of the inflation data that's really kind of told this picture about the consumer right now. Perhaps we start on that. From the Fed's mindset, what do you believe they're saying is the state of the consumer?
Well, I think they think the consumer is doing pretty well. I mean, look at the data this week. I think that's why the market was so upset about retail sales. Right. When it becomes good news is bad news, it means that the focus of the market is on the bond market. It's focusing on rates and whether or not rates are going to move. We've been really focused on the long end of the curve. Take a quick look at the 10-year. Look at the 1-year horizon. What you're going to see is that we're on a steady movement upwards, particularly in yields on the long end of the curve. And we're fixing to get close to breaking out to a new trend in fixed income like we saw last year. And this, to me, indicates that the market is much more focused on, wait a minute, this data is not going to give us smooth sailing into the end of the year with no chance of another hike and also a chance of a cut.
When you say no chance of another hike, so what does the data tell you about, I know there's been a lot of focus on the inverted yield curve. At the same time, you have analysts dropping calls for a recession this year. What do you make of that? Is that something that could actually happen? Could we potentially sidestep a recession with where the yield curve is?
I think that's been the biggest conundrum this year. You've seen this inverted yield curve, which historically tells you recession. So everyone said, okay, the bond curve is telling us recession. But what I think is happening is there's a dislocation between expectations on rates. What's happening is, look at the short-term rates. I mean, I know most of you looking at buying, putting money in a money market, you're like, yes, 5+%. That's awesome.
That's nice.
I know. But then look at the long end of the curve. Who wants to buy a 10-year at 4% or 4.2? So those bonds seem to be either mispriced or there has to be a recession or we have to have a quick normalization. And for me, what has to happen is people need to realize that higher inflation for longer means that long-term debt has to reprice. Once I see that, then I think we can start talking about recession because we need to really understand what the effects of long-term changes in value over really long terms does to the equity market. And until we see that, I think we're kind of waiting to figure out what happens to the yield curve before we figure out where recession could occur or which sectors will be the most challenged in this new environment.
If we are able to sidestep recession, is there any need then for the Fed to cut rates, if some have brought up as well in early 24?
Precisely. That's the challenge, right? I mean, if we're seeing a floor because the consumer's okay on yields, and we're seeing a cap because, the inflation is coming down, it means we're in the middle. It means that we're going to have inflation for longer. Inflation for longer means longer term cash flows discounted.
But does it get back towards their target at the same time? 2% target is what the Fed has set forth. Do we actually reach that target even if we do sidestep a recession and we're in that inflation for longer? But, at what rate do we eventually see that start to trickle lower or trend lower, just as we've seen that lock in over the longer term at this point?
Well, I think we're going to need to see the yield curve move. And what I'm worried about is that it's going to be a realization, that it's not going to be a slow churn upwards, that people one day are just going to say, oh, long-term bonds aren't any good. Kind of like what happened in the banking crisis. That's what worries me, is that after the fact, it's obvious. But before it happens, I mean, you think to yourself, geez, why didn't I buy treasuries?
Yeah.
So that's what I think I'm looking for, is that equities look good. They're not the center of what I'm thinking about. It's really what happens to monetary policy and how does that affect cash flows?
To your point, yeah, I mean, it goes to that point about hindsight being 20/20, and often, even with the recession, or not often, with the recession, we don't know till we're in it.
Yeah, exactly.
And after the fact. I want to go back to the point that you made about the consumer being okay with yields. Is that really like what you see? And are you concerned about the consumer with, I mean, inflation has come down, still elevated, but are you concerned?
Well, I mean, let's take a couple of pros and cons, right? So the pros are inflation seems to be going down. So prices are coming back to normal levels. On the negative side, savings are down, so there's less disposable income, like you guys were talking about. But if prices can normalize and the consumer can navigate some of this, you definitely can see a situation where the consumer is healthy enough, particularly in the U.S. versus other economies, to waver the storm.
Is there anything that could come out in the Fed meeting minutes today that take the markets by storm, that is a surprise that we see come across and gets factored in and priced in at 2 p.m.?
Well, I think the market's down because it's looking for that, right? It's saying, they're probably going to come in and say, just be cautious. This, this isn't over yet. And then I think that's what's priced in already going into this move. Now, the surprise would be if they came out and said, everything's great. We're never going to cut rates. We're going to cut rates soon. I mean, I think that's the surprise.
If they had said that during the meeting, yeah.
I think that's highly unlikely.